Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be doing a market update, which includes stocks, bonds, and commodities. So stocks. The S&P 500 index is down about 20% through the middle of June. Energy and utility sectors have been the best performers, whereas technology, communication, and discretionary stocks have been the worst performers. Investors continue to monitor inflation, interest rates, and the Russia-Ukraine war. So as you can see, at the beginning of the year, the index started at about 4,800 and currently it stands at about 3,667. So as we look at different styles in the United States, focusing on value, blending, growth, through the end of May, you can see that value has held up the best, whereas growth has actually seen the worst of the declines. And looking at it through a sector performance, energy and utilities were actually positive through the end of May, whereas again, technology, communication, and consumer discretionary have been hit the hardest. So the global stock market performance, as you look at the last 2 years, comparing the S&P to Europe and also the emerging markets, the United States continues to be the best place to invest. And the returns have still been north of about 20% versus the developed markets at 9.4% and also emerging at 6.9%. The aggregate bond index, AGG, is down about 11.5% through the middle of June. The Fed has already raised the Fed fund rates by 1.5% since the beginning of the year, and corporate bond yields have risen with Fed hikes and market volatility. Looking at the Barclays Agg, you can see at the beginning of the year it was just shy of $115, and today it stands at about $102 per share. So the Treasury yield curve. If you look at the shape of the Treasury yield curve, starting at the beginning of the year, you can see that the 2-year bond was very low at about 0.73%. And that actual now is at about 3.06%. And the steepness of the curve at the beginning of the year has now flattened out, except for the overnight rate, which is set to come up as the Fed continues to raise interest rates maybe 3 or 4 more times throughout 2022. U.S. corporate bond yields. So as you're looking at the difference between a corporate bond and a treasury bond, we call that a spread, which is the difference in yield that you're getting. And you can see that corporate bond yields have spiked also as volatility has increased and also the Fed has been raising interest rates. Currently, CCC paper pays north of 13% and BB at about 6% and AAA at about 3.7%, which is up almost 100% from where we started at the beginning of the year. Commodities. Commodities have been the best performing asset class in 2022, up over 42% as of the middle of June. Energy, metals, agriculture make up the broad index and have spiked this year due to strong demand and the war in Ukraine. And you can see also this basket started right around 20 at the beginning of the year and stands right now at about $30 per share. So looking at the different asset classes you can invest into, you can see that 2021, most asset classes performed positively, except for emerging markets and also fixed income. Whereas in 2022, it's been a very different story. The only asset class this year, as we discussed, that's positive has been commodities. If you built out a diversified portfolio and it was balanced, you can see that actually you're down about 12% through the middle of June. So it's made it very hard to be an investor where your stocks and your bonds are going down in the same fashion. Thank you for joining us for 3 and 3.